The IPO rush is currently on, and we have Barbeque Nation as well, which has, listed itself for its IPO. Rahul Agrawal, the Chief Executive Officer of Barbeque Nation Hospitality, joins us now on the show. Hi, Rahul. Good afternoon. The company seems to have gotten a very good response in terms of the anchor book. In line with the company's expectations?
Oh, yes, we got a very good response from some of the institutional investors. Yesterday, we closed our anchor book with 15 marquee names, raising approximately 200 odd crores. We have a good mix of mutual funds, top-notch FIIs, a couple of domestic funds, and an insurance company.
All right. What are the key value propositions of Barbeque Nations, the product, the IPO? What are the plans for the company?
So we are one of the leading casual dining chain in the country, grown pretty well, started in 2006, and in last 15 years had built up a scalable business, did approximately 850 crores top line in FY 20, and then also very profitable at EBITDA margins level. I think our business at the dining level is still very underpenetrated. We only have, like I said, 150 outlets, and I see huge potential in expanding this network to other parts of the country and also in existing markets. Secondly, we have a now very good and sustainable delivery business. Last year, our delivery portion was only 3%. We focus excessively on delivery this year, given COVID. And today, the proportion of delivery in our total business is approximately 15%. And this business will also grow very well. Also, we are one of the largest player in Indian cuisine, which is the largest market in Indian food services space. So I think a mix of both dining and delivery will do extremely well for us in future.
What are the changes that the company has made during COVID to reduce the impact so that cost can be lower as the sales took a hit?
So there are a lot of structural changes done at the outlet. We had changed some service sequence. We have reduced the number of manpower required in an outlet by approximately 7 to 8% than it was required pre-COVID. Those are more sustainable savings. We have also renegotiated some of our rental agreements, which had moved to revenue share models. Some of the rental agreements also had temporary reliefs. At the back end, we have given a lot of work that we have done on tech side over the last 2 years. We have also reduced our back end cost by approximately 20 odd percentage. So these are changes that are there on the cost side. And like I said, on the revenue side, the incremental business that we are getting from the existing infrastructure coming from delivery is very sustainable and a long-term growth potential for us.
The company has been making loss for a few years now. COVID, of course, has only accelerated that. When do you expect to see a turnaround?
So, like you said, EBITDA has been very healthy for us, and we have to understand that we've added almost 50% of capacity that we have in last 3 years, and some of these restaurants have still not matured. They grow year on year. They have been growing year on year. We have absolutely no problem in those restaurants. And the depreciation is also higher because these are new. So the impact of that is leading down to lower PAT levels. Also, finance cost was high given some of the debt that got built up because of one acquisition and also the investment that we made in international market. That anyway is auto correcting. We raised 150 crore in pre-IPO. We used part of that proceeds to pay our debt. Now the anchor book is done. Hopefully we'll close our IPO, and this money will also be utilized to significantly bring down our debt. With that, I think the difference between your EBITDA and your PAT margins will shrink, and we would come back to PAT positive.
All right. Online ordering, delivery, etc. has taken the front seat. Do you think that this could reduce the preference for dine-in? And also, would you consider then, on expanding the delivery, home delivery and the online ordering segment?
So it will be a mix of both. We will have both dine-in and delivery as the key focus area. Yes, delivery is growing very fast. and we also have a model to take a good proportion of that delivery market. But dine-in also, will come back. I don't think is a problem. If you look at our numbers post-COVID, month on month, we have seen our dine-in business also recovering, and in my view, both will coexist. And some of the organized players like us will also benefit more because of people's uh, preference towards going and consuming branded player than any of the unorganized player. So I think we are looking at both. We're looking at both dine-in and delivery as our future growth strategy.
So between delivery and dine-in, what's the revenue mix we can expect?
So very difficult to give a guidance on that, but historically the last number that we reported was November 2020, wherein we did 85% from dine-in and 15% from delivery. As a company, we are focused on growing both. We track a matrix called dine-in revenue per restaurant per year and average daily sales per restaurant per day on the delivery front. So that number has grown almost 3.5x over last year, and I think it is still underutilized. So the market is big. We are still not a very large number in terms of what we do and what others do, and over a period of time, this will grow further.
The company has been seeing a steady growth in the store opening. What is the expansion plan for the company? How does the company look to give this in the current scenario?
Yes, so FY21 we didn't expand. The focus was on revival. I think we have done that. We are pretty well spread out. Even though in some cases you might see some supply side restrictions, some lockdowns. I think other parts of the country are doing good, and we don't invest for a year or so. We have always invested for 12 to 15 years in one site, and we would plan to open more outlets this year. In fact, some of these sites are already under discussions. And historically, we have opened between 20 25 sites every year. I think we will continue that trend in future also.
While COVID has, of course, impacted the same store sales growth, how do you see that shaping up in FY21?
So it should come back. Even FY21 also would be subdued because the entire year also have impact of H1, which was largely impacted because of COVID. But I think going forward with additional revenues coming from delivery business, the SSGs should be better than what we did in the past.
So, with street vendors, unorganized players not exactly in action, do you think you gain market share?
Oh yes, the industry overall has grown at around 9% historically, and we have grown over the last 2 to 3 years at 20% CAGR. So yes, our market share in the entire food services market has grown over last 3 years.
All the very best, and thank you so much for joining us today.